Hi, I'm Jimmy. In this video, we're looking at where the US economy could go in 2021. So our main focus is going to be on GDP, which is short for gross domestic product. And we're going to see if we can try to figure out how that could influence the stock market going through 2021. And then hopefully we can use that information to make better investment decisions and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump into this thing. So this is a chart of US gross domestic product going all the way back to the year 2000. Now these are year-over-year changes. And just so we're all on the same page, each dot here represents a different quarter. GDP comes out quarterly. And it's also very important for us to recognize that, just as an example, take this one quarter here. This is the second quarter of 2020. Well, that number came in at negative 9%. But because this is a quarterly number, what economists do is they annualize the number. So we can't look at this and say, oh my God, GDP fell by 9%. It was actually slightly more than 2%. It was something like 2.25%, 2.25%. But when you annualize that, well, you get to be about 9%. So these numbers oftentimes can look much worse than they really are. So if GDP grew by, let's say, 1%, well, if that was 1% over a quarter, well, they would show that as a 4% annualized number. So I just want to point out the way the quarterly numbers actually work. Okay, so where is GDP going in 2021, and what impact could this have on the stock market? Well, to project where GDP could go, it's important that we look at the GDP formula. And the good news is that each piece of the GDP formula is closely tracked and projected by many, many economists. So we're going to use those projections or forecasts to see if we can gauge where the overall economy is going to go in 2021. Now, just so we're on the same page as far as this formula goes, well, consumption is generally referring to consumer spending. How much are people going to consume in 2021? And since these numbers are presented in year-over-year changes, well, how much are people going to consume in 2021 versus 2020? Then we have the investment side of it. This is how much private domestic investments happen. So how much will businesses invest within their own country? So are they building new factories or buying new manufacturing machines or new buildings, things along those lines? Okay, then we have government spending. I think this one's probably quite obvious. How much is the government spending? And are they building any new roads? Maybe they're putting up new infrastructure, new bridges, things along those lines. And everything has a ripple effect on everything else. So if the government is paying to repair a bridge, let's say, well, they're going to go out and outsource that bridge work. They're going to contract out that work to a company that repairs bridges. That company is going to hire people. So in theory, the business goes out and does investments. Maybe they have to buy new machines to repair the bridge, whatever it is. So they increase the investment side of this. They then hire their people. They pay their people. Those people spend more money. That increases the consumer spending. The government spending goes up. So a single action, especially by the government, can really have a ripple effect on the overall economy. But that's true on pretty much every spending. If a business goes out and spends, well, their investments go up, and consumer spending, in theory, should also go up. So we can see how this would affect the economy as a whole. Now, the same general concept would apply with the stimulus that the government's trying to do. So if the government writes stimulus checks to individuals, well, in theory, consumer spending will go up. If they do it for businesses, well, investments would go up. And perhaps consumer spending if they were to pay their employees. Of course, the assumption there is that the businesses pass through that cash that they get from the government through wages, which, as we all know, isn't always the case. But either way, the concept remains the same. Okay, then we have net exports. Net exports uses both imports and exports. So basically, we take exports, which is marked with X, we subtract M, which is the indicator for imports, and what you end up with is net exports. So, of course, the more exports that a country has, in theory, the more manufacturing they are doing, the more products that they're creating, and the higher that will affect GDP. If we import too much, that will be a negative effect on GDP. Okay, so now let's look at some projections. So what I did is I tried to find projections or forecasts for each of the components of GDP. So I was able to find some on a site like Bloomberg.com or some on CNBC.com. I was also able to find some individual investment research reports or articles written about what economists were saying at individual investment banks. And if you have a paid subscription, a lot of this is a lot easier. But if you don't, here's what I was able to find. So for consumption, well, we're really talking about consumer spending. And we can see that here in 2020, well, we're showing a negative number of 3.8%. And given everything that's happened in 2020, I'm sure this is no surprise to anybody. Now, technically, this 2020 number is still a projection since the fourth quarter of 2020 hasn't been reported yet. That's expected to be reported in January of 2021. Well, the average economist for 2021 is projecting, on average, 4.6% positive number for consumer spending. Now, these are year-over-year changes, and as we know, 2020 was a bad year, so it's probably not too surprising that 2021 could come out with a very solid year. Of course, this assumes that the coronavirus gets under control, that the vaccine works as well as it's supposed to work, and it happens in the not too distant future. Now, I do want to point out that this 4.6% is just an average of the numbers that we could find. So I saw a company like Credit Suisse. Well, they're expecting a much lower number at 3.6%. A company like Goldman Sachs, I believe their number came in at 5.5%. So the numbers can really swing based on which economists we're listening to. But for me, I think it makes much more sense to simply stick with the averages, because any one analyst could be wrong at any given time. But if you put them all together, on average, you end up with much more accurate numbers, especially in ordinary times. So excluding something like the coronavirus where everybody was wrong, in most ordinary times, analysts, economists tend to do an okay job of getting at least close. So if we take the average, we should be safe. And here's hoping that 2021 is a more normal time. Okay, now we shift over to investments. Now, investments are a bit more of a volatile number than something like consumption is or consumer spending is. So 2020 is projected to end with a negative 6% growth rate. But in 2021, that number is expected to turn around and give us a positive growth rate of 7.5%, which is clearly the best annual number that this indicator has seen going back to 2013. So this should be a good sign for the overall economy. Then on the low end, I saw as low as 4.9%. On the high end, as high as 10.5%. So once again, the range is large, but this is where the average is. Now, if we jump over to the GDP formula, just so we can break this down a bit, well, we've already got consumption. That was 4.6%. And then the investments are estimated to be 7.5%. Government spending is actually estimated to be flat. That came in at 0%. Now, of course, once again, just like the other numbers, we have ranges on the low end all the way to the high end, but on average, we're showing 0% for investment or for government spending. And again, I do want to point out that just so we're all on the same page, we are not saying that the government won't spend anything. Obviously, that's crazy. I'm just pointing out that the projections are right now that they will spend just as much in 2021 as they did in 2020. So no additional growth. Considering what they've spent in 2020, that's a lot of spending in 2021. Okay, now we shift over to net exports. So for exports, I was able to find an expectation of 5.3%. And then imports are expected to be 8.5%. So if we do that very simple math, well, we end up with net exports of negative 2.9%. So clearly, net exports are going to be a negative thing for the broader economy, or at least for the GDP numbers. Now, at the end of 2021, it is expected that we will see, on average, growth of 3.9% for the broader economy. That's what GDP is right now estimated to be at the end of 2021. Now, if we were to add these numbers up, if we were to do this quick math, well, we might realize this does not add up anywhere near 3.9%. And that's because every piece of GDP does not contribute the same amount to overall GDP numbers. In fact, it's consumer spending that is the primary driver from a dollar's perspective on where GDP ultimately goes. Government spending is a decent number. All of these have different weights, so it's really you can't really add up percentages. If we wanted to do it a more technical way, well, I would have used actual dollar numbers and then we could add those up. But those numbers are frankly in trillions and trillions of dollars. I think it's much easier to look at these from a percentage perspective. I just want to point out that we shouldn't take those numbers and add them up and wonder why it's not working. So when we pull up a chart of GDP going back the past 50 years, well, we can see that this negative 2020 number was the worst number in our entire time period. And then when we add the projections for 2021, well, we can see that this is one of the highest jumps in the past 20 years or so. So that should be a good thing overall. Now, for anybody who watches the stock market on a regular basis, well, we probably realize that oftentimes the stock market moves not necessarily based on what's actually happening, but on expectations. This is pretty much the only way to explain why the stock market is up as high as it is right now, given that right now the actual numbers are way down here. So clearly 2021 is expected to be a positive number, and these expectations are a good thing, as we can see from the past 20 years. And I can logic out how they're up so high. We are coming off of a very bad year, so year over year numbers are going to look pretty good. So I'm not too surprised that numbers are up this high, but I am worried that they are up too high. Projections, expectations are up too high. What if unemployment rises slower than it has been? What if the vaccine rollout doesn't go as positively as everybody's hoping it will? I think that at this point, near-term expectations are things are going to turn out like this. What if things don't begin to get normal for 6 months instead of 3 months, or whatever the projections actually are? If that's the case, we don't end up at 3.9% positive GDP numbers. What if we end up at positive 2%? What happens to the stock market in that scenario? To my way of thinking, there's a whole bunch of ways that these projections can come up short. Granted, the opposite is also true. Perhaps the economy outperforms, and these expectations for the stock market, the reason the stock market is up as high as it is with all the government spending, everything that the Treasury is doing, everything that the Federal Reserve is doing, perhaps that's enough to spur the economy. Maybe unemployment comes in better than we expected. And if that's the case, then it's possible that GDP and ultimately the S&P 500 keep moving forward. It's also possible that, let's pretend the S&P 500 doesn't fall. What if it just stalls out for the next year while everything is sort of sorted out? Now, I don't truly expect it to stall out. I don't expect volatility. But let's imagine that, looking at the S&P 500 chart, a year from now, we're about in the same spot. That is very possible. And if that's the case, then any investments we would have made in the broader market didn't return all that much for us, so that would be a bad thing from an investment standpoint. Now, of course, it's always possible that any given stock could do great or terrible based on the company's fundamentals or news about the company, whatever it might be. But with these expectations for the broader market, I think it's important for us to pay very close attention to the key indicators or the key drivers of the broader economy, and then be prepared for some volatility within the stock market. So my plan personally is to continue to dig as deep as I can on as many companies as I can, looking for great long-term investments that can weather the inevitable volatility of the broader economy. Now, if you're curious how to do a deep dive on a stock, well, I actually went through a video where I talk about 8 simple steps to analyze the stock. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.